Silver prices should have collapsed by now. Industrial demand is breaking records, vault inventories are thinning, and geopolitical tensions are tightening supply routes across continents. Yet the market refuses to fall. Every dip is absorbed. Every sell-off finds a floor. Behind the scenes, something unusual is happening. Warehouses are emptying faster than they can be replenished. Banks are stepping away from retail silver altogether. And quietly, without any announcement, someone just committed nearly $650 million to physical silver purchases. Not to speculate, not to hedge, but to hold the line. So the question is no longer whether silver is scarce. It's who is strong enough to decide the price doesn't move anymore. To understand why silver is behaving so differently today, it is necessary to step back and examine how the market itself is structured and how far it has drifted from physical reality. For most of history, silver was not simply a commodity, it was money. Until the mid-1960s, silver coins still circulated as legal tender in the United States, and for centuries before that, silver functioned as a universal medium of exchange across empires. That role ended when governments transitioned fully to fiat currencies, severing the link between money and scarce metals. Modern silver trading is now dominated by futures markets. These contracts allow buyers and sellers to agree on prices for future delivery, often without any intention of exchanging physical metal. In theory, futures provide stability and price discovery. In practice, they have created a system where silver can be traded many times over without ever leaving a vault. This distinction between paper silver and physical silver is central to understanding today's tensions. On exchanges such as COMEX, prices are largely set by the volume of contracts traded, not by the availability of metal. As long as most participants settle contracts in cash, the system functions smoothly, even when physical inventories decline. Occasionally, however, stress becomes visible. One such signal is backwardation, a condition where immediate delivery costs more than future promises. In commodity markets, this is rare and significant. It suggests that buyers are no longer comfortable waiting. That possession now matters more than price later. Silver has tested this system before. In 1980, during the Hunt Brothers episode, physical demand overwhelmed paper supply and prices surged. The response was not increased transparency, but rule changes. Exchanges restricted buying, raised margins, and reversed the trend almost overnight. The message was clear. When silver threatens financial stability, market rules are flexible. Today, the stakes are higher. Silver is no longer only a monetary metal. It is a critical industrial input, embedded in energy systems, technology, and defense infrastructure. Disruptions now extend far beyond investors, which raises a fundamental question. If silver is essential, scarce, and increasingly strategic, why does its price still appear so controlled? The silver shortage is not the result of sudden speculation. It is the outcome of long-term structural limits. In 2024, global industrial demand for silver reached approximately 680.5 million ounces, while total supply failed to keep pace, creating an annual deficit of nearly 149 million ounces. This gap is not new. It has widened steadily over the past decade, turning temporary shortages into a persistent condition. The core problem lies in how silver is produced. Around 70% of global silver output comes as a byproduct of copper, zinc, and lead mining. As a result, silver supply does not respond directly to silver prices. Even sharp price increases do little to incentivize new production, because investment decisions depend on entirely different metals. Mining constraints further compound the issue. Declining ore grades, rising energy costs, environmental regulations, and long permitting timelines mean that new supply can take more than a decade to materialize. Recycling offers limited relief, as much industrial silver is dispersed in small quantities and is difficult to recover economically. As deficits accumulate, above-ground stockpiles are quietly being drawn down. The market is no longer absorbing surplus, it is consuming reserves. Silver demand today is driven less by consumers and more by systems that cannot easily pause. Silver is essential to solar panels, electric vehicles, data centers, telecommunications, and advanced weapon systems. Its electrical and thermal properties make it difficult to substitute without reducing efficiency or reliability. As governments accelerate energy transitions and digital infrastructure, demand continues to rise regardless of price fluctuations. The strain became visible in Shanghai, where silver inventories reportedly fell by over 86% in a short period. What followed was even more telling. Roughly 660 metric tons of silver were rapidly shipped from Asia to London, not for arbitrage, but to stabilize Western vaults facing depletion. This was not routine trade. It was a logistical response to stress. Unlike consumer markets, strategic and industrial users do not wait for price corrections. Access matters more than cost. When shortages emerge, allocation shifts from markets to priorities. As silver becomes increasingly embedded in national infrastructure and defense systems, it stops behaving like a discretionary commodity. It becomes a strategic material, one that governments and industries compete to secure first rather than bid for publicly. If physical supply and demand point upward, the paper market explains why prices remain restrained. Silver pricing is largely set on futures exchanges such as COMEX, where contracts represent promises rather than physical delivery. Estimates suggest that for every ounce of registered silver, there may be 100 to 400 paper claims outstanding. This imbalance allows large financial institutions to influence prices through volume, even when physical metal is scarce. By expanding short positions and adjusting margin requirements, bullion banks can increase the appearance of supply and dampen price signals. As long as most participants accept cash settlement, the system functions, even as inventories decline. History shows how fragile this structure can be. In 1980, when physical demand surged during the Hunt Brothers episode, exchanges responded by restricting purchases and forcing liquidation. Prices collapsed not because silver became abundant, but because rules changed. Today, leverage is higher and inventories are thinner. If even a small share of contract holders demanded physical delivery, available supply could be overwhelmed. The system depends on confidence, and confidence once lost cannot be settled in cash. As silver tightens, governments have begun treating it less as a commodity and more as a strategic asset. China has quietly restricted retail access to precious metals while incorporating silver into broader stockpiling policies. Officials have signaled tighter export controls beginning in 2026, echoing China's earlier strategy with rare earth elements. That playbook, control supply, influence price, shape global dependence, has already proven effective. In South Korea, major banks suspended silver sales in early 2025 without public explanation. No shortages were announced, yet access was cut. Historically, such moves signal precaution, not abundance. Meanwhile, Russia's exclusion from Western bullion markets has fragmented global supply flows, reducing liquidity where demand is highest. Against this backdrop, the $650 million silver purchase stands out. Transactions of that scale are rarely speculative. They suggest urgency, coordination, and preparation, possibly by a sovereign actor or strategic fund acting on behalf of one. The goal may not have been profit, but positioning. Because when metals become strategic, securing supply matters far more than predicting price. To understand where the silver market may be heading, it helps to look at where similar systems have already gone. One of the closest parallels is the rare earth market. For years, rare earth elements were treated as obscure industrial inputs. Prices were low, supply chains were global, and few questioned the concentration of production. That changed when geopolitical tensions revealed a hard reality. China controls roughly 70% of global rare earth mining and more than 90% of refining capacity. When exports were restricted, prices surged, supply chains fractured, and entire industries were forced to adapt. Silver shares uncomfortable similarities. It is essential, difficult to substitute, and increasingly concentrated in the hands of a few strategic players. The difference is visibility. Rare earths made headlines only after disruption. Silver may be following the same trajectory, quietly. Another signal comes from the gold-to-silver ratio, a long-standing metric used to assess relative valuation. Historically, this ratio has averaged around 69.1. Today, it hovers closer to 79.1, suggesting that silver remains undervalued relative to gold. In previous cycles, such imbalances did not resolve gradually. They corrected sharply. The consequences of continued distortion are significant. For the green energy sector, silver shortages translate directly into higher production costs. Solar manufacturers already face margin pressure. Any sustained increase in silver prices could slow deployment, complicating climate targets and energy transitions. For technology and defense, access matters more than price. Interruptions in supply threaten timelines, contracts, and readiness. The most immediate systemic risk lies within the financial infrastructure itself. Exchanges like COMEX rely on the assumption that most participants will accept cash settlement rather than demand physical delivery. If even 10% of contract holders were to request metal simultaneously, available inventories could prove insufficient. The result would not simply be volatility, but a crisis of credibility. There is also a geopolitical divide forming. Nations with the capacity to stockpile gain resilience. Those dependent on open markets become exposed. In such an environment, silver ceases to be just a traded commodity. It becomes a marker of strategic advantage. History suggests that when this line is crossed, markets do not adjust politely. They reprice violently. When a market reaches this stage, strained supply, distorted pricing, and rising geopolitical control, the question is no longer whether change is coming, but who adapts first. For governments, the most immediate challenge is transparency. Strategic stockpiles of silver exist, but their size and accessibility are rarely disclosed. Without clarity, markets operate in the dark, amplifying volatility and mistrust. Longer term, nations are being forced to reconsider supply chains that rely almost entirely on global trade. Domestic refining, recycling incentives, and strategic reserves are no longer optional policies. They are becoming defensive necessities. For industry, the problem is more practical. Manufacturers cannot wait for markets to resolve themselves. Some are already redesigning products to reduce silver intensity, substituting where possible, optimizing where not. Recycling initiatives are expanding, but they face physical limits. Efficiency can slow the bleed. It cannot reverse structural scarcity. For investors, the distinction between exposure and ownership has never been more important. Paper contracts offer liquidity, but they rely on counterparties and confidence. Physical silver, by contrast, offers certainty but sacrifices convenience. As trust in paper systems is tested, this trade-off becomes increasingly visible. Looking forward, analysts have outlined several possible price trajectories. In a base case, gradual supply tightening and steady demand could push silver into the $75 to $100 range by 2026, aligning with forecasts from institutions such as Bank of America. In a more severe scenario, where confidence in paper markets erodes or delivery failures emerge, prices could overshoot dramatically, reaching $120 to $170 as physical metal reprices to reflect scarcity. A downside scenario remains possible. Strategic stockpile releases, particularly from China, could temporarily suppress prices. But such moves would likely trade short-term relief for long-term vulnerability. Each path carries risk. Each carries opportunity. What unites them is uncertainty, and the growing realization that silver is no longer governed by simple market forces. The silver market is not experiencing a random shock. It is moving through a familiar cycle. First comes complacency, when prices remain low and supply appears stable. Then manipulation, as paper markets expand and distort signals. Next comes the squeeze, shrinking inventories, rising strategic demand, and quiet restrictions on access. Today, silver is firmly in this third stage. Over the past decade, cumulative deficits have reached an estimated 820 million ounces. Vaults are thinning, governments are tightening control, and somewhere in the background, a buyer committed $650 million not to chase returns, but to secure stability. That purchase was likely about time, not profit. Time to prepare, time to secure supply, time to hold the line before the rules change. The question now is not where silver goes next, but who will still have access when it does.